can prove that those costs are going to recover. And if those costs are going to recover, then your revenue is going to be your cost. So how much profit are you showing? 0, but you need to prove what? That it is going to be recoverable. And we need business documentation. Once again, a slight change, but a very mean one. In the previous IAS 11, this rule was the other way. What was the rule? Recognize the completed contract method. Recognize the revenue until costs are incurred to make 0, unless the contract is loss-making. Yes. Now they turn it around. Recognize no revenue unless you can prove that the contract is recovering the cost. Yeah? Now, for the construction business guys, your percentage of completion is 7%. What are you going to say? I don't have a clue how is it going to end. Because maybe I am drilling a tunnel, and in the middle of the mountain I will find a wall of diamonds, right? And I go through it. But, well, that's not the obvious case, but I will have some difficulties. So it will be very hard to prove that at least my costs are going to incur. And you are going to get questions regarding this.
But the payment terms, you can know that that cost will be paid by the client.
But you will never know that maybe your expenses will exceed all the expectations you have. And previously, you needed to prove it which way?
Other way.
Other way. Okay? Now, if it's at the point of time, this is what you are going to do. The following indicators are going to be used when the revenue is going to be calculated. Look, very important. The entity has a present right to the payment for the goods or service. That's number one. That's number one. Okay? So if you have the present right, then it most probably means that you earn the revenue. Or the customer has the legal right of the asset, or the customer has physical possession, or the customer has the significant risk and rewards of the ownership of the asset. But basically, these are coming from which part? It's IAS 18, it's word by word. Okay? And the entity has the evidence of the customer's acceptance of the asset. To be honest, that's the least important part. The most important part is coming now. What if I don't have any of those? When am I going to recognize the revenue? Once again, when? Payment is actually received. Payment is actually made. Now, I'm not going to do example 2, okay, guys? It's a simple POC method, and we are very well aware of this. So these ones I am not going to deal with. However, I will deal with contract costs, because that is an important change. Obtaining the contract. If I spend money on obtaining the contract, if I spend the money on obtaining the contract, what is that? Okay, I'm not talking about bribes. I'm talking about things, what you need to pay in order to be able to do the contract, like marketing, initial planning, gifts. Thank you. So basically, yes, you're right. What we have is the following. The incremental cost of obtaining the contract needs to be capitalized if you think that these are going to be recovered. How do you know that these are going to be recovered? You will obtain the contract, and the contract is going to be a profit-making thing. So you will have a new line in your statement of financial position in your balance sheet. What is the name of the new line? Cost of the contract, cost of obtaining the contract. So you will have an asset there. Okay, and how are you going to amortize it? Over the period of the work is done. All right. So basically, that's a prepaid expense type of thing, right? What you are allowed to amortize over the time. Hold on for a second. Did we have this rule before? Yes, we did. In IAS 11 only. Yeah, but now we have it everywhere. So basically every contract now may be having these type of characteristics. Okay? And what is cost of, yeah, hold on for a second, there is a practical expedient. If you don't want to capitalize it, you are allowed not to. So if you don't want to work with, that's actually an exception. If your accounting policy that your cost of obtaining the contract will be expensed immediately, that is also acceptable. Yeah?
What if one client gives you two projects on a condition that you first do the first project, which is a loss making, and if we do this project, he'll give us a bigger project?
Okay, this is not two contracts. This is one contract.
And can we capitalize that loss on the first
No,
project?
no, hold on for a second. That is one contract with two performance obligations, because you wouldn't take the first one without the second one. Remember the bundling thing?
Yes, yes.
That is actually not sold separately. Nobody would take the first one without the second one, would they? No. So that's one contract. How many performance obligations? Two. How are you going to split the price between the two? Standalone selling price. So for how much would you do the first one if it was a loan granted to you, and the second one? Got it?
And then there will be no loss.
And then it's going to be, well, I don't know if there is going to be a loss or not, but at the end of the day, I assume if you are not totally, lunatic, you are not going to take it. Unless altogether it's going to be a profit making.
Well, specific on Nadi now, amount paid as a commission or a service fees to get 100% undertaking of an offtake of your goods.
No, once again, come again, I didn't get this. All right.
Service fees paid.
Yeah, you get service fees, yeah?
In consideration of a 100% offtake from an entity.
Uh-huh.
That yes, they will. The funding customers will not have a problem.
Uh-huh.
If they are not funding customers, they'll offtake. They'll take away the product.
Yeah.
Service fees paid for that. With
That's
that
obtaining the contract. You are right. And actually, to be honest, you pay this fee to them, right? Which means that you can capitalize it, because that's basically the price of obtaining the contract. You need to prove that you are going to be able to recover it. But you can prove it immediately. Why? Because if they don't find you a customer, they will take your product. So actually you capitalize it, and when are you going to take it out of your balance sheet? When actually you recognize the revenue. Okay? At the end of the day, it's like selling the goods immediately, but you didn't sell the goods, because in order to sell the goods you have to prove, don't go back, one of these. And probably the present right to the payment is going to be either when they find a customer, or when the time frame elapsed and you have to give them the products. Okay?
Professor,
About the non-refundable, your tenant default for a building which you, it depends. Usually you actually treat it as part of what? As part of your rental fee, if it's a non-refundable. So you have to pay an amount for rent a building at the beginning, which is not going to be refundable. What is it usually used for? Either for damages, right? Or actually it is just a way of getting more rental fee. Yeah? Depending on which is the objective, you are going to account for it. If it's only used for damages, until how long you need to defer it? Until the end of the And what if it's actually not for the damages, but it's actually a rental fee collected in advance, then you are going to amortize it over the rental period. Got it? Okay.
Professor, this cost of obtaining a contract is obviously before that contract is awarded.
Yes. It's actually yes. And I already told you the practical expedient, and there is one more. Expense if amortization period is less than 1 year. Why? Because at the end of the day, if it's less than 1 year, it doesn't going to make a difference. It is just a bookkeeping entry. Now, what is cost to fulfill? Cost to fulfill is going to be actually which is relate directly to the contract and generate or enhance resources that will be used to satisfy performance obligation in the future. So, for instance, you are buying a machine or something. Okay? What are you going to do with them? You are going to capitalize them, but it's going to be under another IFR. That's why, for instance, property, plant, and equipment. Okay? So that's not an issue over here. Okay, other topics. Look over here, incremental cost of obtaining a business. Entity A has the following incentive plans. A bonus plan for sales employees based on a new contract signed during the month. The next one, a bonus plan for sale employees based on combination of APS and individual performance evaluations. Now, which one may be capitalized, which one may be not capitalized? What do you think? The first one is capitalized. Why? Because that is cost of obtaining a contract. What about the second one? Isn't it the cost of obtaining a contract? No, that's continuous cost. Okay? So a typical cost of obtaining a contract is, for instance, this one. Right? When you are paying a bonus to who? To your sales employees if they bring a new contract. You can capitalize it until when? Until the revenue which they bought starts to be generated.
If it is more than 1 year.
If it's less than 1 year, it won't make a difference, right? Okay. Now, breakage we just skip. Licenses we just actually skip. You will be able to read it. We already talked about the intellectual property, right? What's the difference between the intellectual property? If it's granted as is, when do we recognize the revenue? Immediately. If it is granted and I promise I will enhance it, I already explained you that, then we are going to do it over the time, right? Now, we already talked about this. Now, the last one, I would like to talk about this because this is an exception where there are no, how shall I put it, there are no exceptions. Okay, let's see. Software entity enters into a transaction with a retail entity too. License existing software product that manages online sales, which is delivered immediately, and provide professional services to build a website interface that will enhance normal features and functionality of the online order and sale management software to be delivered in 6 months. The entity determines goods and services are distinct, and this is what is the selling price. Entity will receive $12,000 fixed fee plus 0.05% of revenue generated from the retailer's website for the next 15 months. The contract does not include, and the customer does not expect, any other enhancement to the software license. So this one, right? This one. So it's just as is. Okay? Variable consideration is allocated to both performance obligations. Now my question is, don't go further, okay? Don't look at the solution. Try to think. Which revenue? How are you going to record the revenue? What are you going to do with the $12,000? When are you going to record it?
Standalone, right?
Yes, because that is something what you provided as is. You give an intellectual property when? Immediately. What are you going to do with the sale-based revenues? Okay, this one is actually easy. I tell you why. Can you include variable consideration? Of course you can. This is what we studied. Now that's the exception. If you have a usage-based royalty, usage-based royalties are only accounted for when the usage actually happens. So you have to wait until the sale is actually being done and you take the 0.05%. Okay? So in this case, there is no room for estimation. What is that? Intellectual property, which is working like a royalty, user-based. User-based, usage-based. Okay? Now,
so you recognize the 12,000 upfront?
Immediately. Yeah.
But then again, you have two performance obligations. One is the license, the other one is the website.
Yeah, the website, you cannot estimate anything there. You have to wait. That's the exception. That if it's a royalty which is usage-based, you need to wait until the usage actually happens.
So you don't allocate the 12,000 fixed fee received to anything?
Actually, there is going to be, so this part, the 12,000, you don't allocate, you don't play around and allocate it. Okay. Now, let's go to gift cards. That's easy. Gift cards. There is an outstanding performance obligation for gift cards. So when are the revenue going to be recorded? When the gift card is either used or expires. Okay? That was easy. Right? And the last one, sale and repurchase agreement. Hold on. Not for sure. This is becoming more and more complicated. A sale subject to an entity's unconditional obligation or right to repurchase the asset, a forward or a call option, would not be within the scope of the revenue standard. So if you know that you are going to repurchase the asset, then the sale is never going to be it's never going to be a revenue. But it's going to be a lease if the repurchase price is less. Why? Why? Because the difference between the repurchase price and the original selling price is going to be what? It's a rental fee. Right? It's a rental fee. Got it? Okay?
Yes.
Now, what is happening if it's the other way?
It's a
You
finance
purchase
cost.
something and you will, so you sold something and you repurchased at a higher price.
Finance cost.
That's basically a loan which is backed up by an asset, right? So that is going to be a financing facility, okay? So at the end of the day, none of them are going to be under the scope of the revenue, but the repurchase agreement is either a lease or a financing arrangement. Okay? Now, I promise that this is the last slide regarding revenues, because by now you should be very confused. And that's why. Okay? No. I promise that this is the last slide. Two more very small sentences. One of them is the bill and hold. Okay? Bill and hold is still existing. What is a bill and hold agreement? Bill and hold agreement is going to be when I actually pay the amount and then I ask my seller, please keep it there, okay? Please keep it there, and I will take away the goods from you later. All right? Can you record the revenue? Yes, you can record the revenue if the customer must have requested the contract to be on bill and hold basis, so it's not me. The product must be identified separately. The product currently must be ready for delivery, and the entity cannot use the product. Where is this coming from? Current standard. There is only one more thing that you need to remember. If there is a bill and hold, you need to assess that maybe the selling price includes another performance obligation for what? For storage. If there is a storage in it, so the price is sometimes higher if you have bill and hold. Why? Because the difference is for what? Storage. Storage, is it over the time or point in time? Why? Why? Come on, why? Out of the three, why? You provide a service that the other party immediately consumes, right? Storage space.
Yeah.
Right? I know. Yes. Okay. Now, let's go. The other one is principal versus agent. We were talking about that. When are you a principal? When are you an agent? Okay. What is the main line? What is the bottom line? When are you a principal? If you have what?
Ownership.
No, not ownership. Not control, not really control, because it's very hard to explain what is meant by control in case of inventory. Where are we having the inventory, control over the inventory? If I have the what type of risk?
Risk and reward.
Inventory risk. So if the price of the inventory goes down, whose problem is that? Okay? If it's my problem, most probably I am going to be a principal. If it's not my problem, I'm going to be an agent. Okay? But if you have these type of contracts, I made a nice table for you guys that the net indicators that you are an agent is that you are not the primary obligator, that you do not have the inventory risk, and you do not have the latitude in establishing the prices, and the consideration is in the form of commission, not really a selling price. Guys, we just finished, I announced, we just finished the 5 steps. if I would ask you now to repeat what I said. No. Hold on. There is something where I want to arrive at this. You would probably be able to remember 10%. Not more. Not more. Why? Because all the rules are tiny. Right? The main things, they do not change. But there are so many tiny rules that you need to be aware of that this is going to require a real job to understand what is going to be the impact. The only thing I want you to do, starting basically from tomorrow, is that you are aware what is in the standard, because it's impossible to learn. So what you are going to do is just be aware that if you have this one, oh, there is a rule in IFRS 15, so I need to go and look it up. And maybe after 5 years, 7 or 10, depending on the individual case, you are going to be able to remember all of it. Look, how long was the standard IAS 18 and IAS 11 together? Who knows? It was 21 pages. Now this one, which is 58 pages, are only the main rules. Okay? Then we have another 120 something pages, which is the detailed rules. And the other issue that I would like to point out, you know when you have to read the standard like this? It's a standard like that. So you have to go word by word. What do they mean? And you know that sometimes you have to do, okay, you have to go to this page, all right, but this sends me to that page. It's a standard like that, so you need all 5 fingers in order to be able to remember. No, honestly. Last week we were building a model for this big telecommunication company. And I don't know if you ever had this feeling that we found a rule and then said, as described in paragraph that. Okay, let's go to that paragraph. What is it saying? As described in paragraph that. Go further. And then we done it 2 more times. And then when we ended up, I'm the CFO and I both looked up that. What was the original question? Now, I don't want to scare you guys. I just want to say that be aware. If you know IAS 18 and IAS 11, you know the framework. But the little things that changed, a lot. And actually, you see how many pages that 100 in your book? These are only the outline. Right? However, disclosures, very quickly, really very quickly. I'm not going to read it out. Disclosures, you need to desegregate the revenue, which means that the revenue must be split according to the main features. Okay? That is going to be easy. You need to be ready for that. And this is what I want to come. To. You remember I already told you that it's 1st of January 2017. Look. This was the revised proposal. This is the final revenue standard. It was here in May. Okay? Now, obviously, the early application will not be able to begin before 2015. Okay? Now, if you are only starting it in 2017, and I really do think that people will need that much time to get ready for the standard, then the modified retrospective application date is going to be this one. But if you are actually doing the full retrospective, you need to restate all your numbers starting from 2015. And the reason for that is pretty easy, because in order to be able to adjust retained earnings, what do you need to do? You need to go how many years back? 2. Okay?
You still have to, if, let's say, for example, the contract was completed
before these dates, right?
Before 1st of January 2017.
Oh, hold on. That's not a good example. If it was completed here, you don't need to deal with it. But if it was completed here, because of the transition period, you need to restate it if you are using the full method. What was the other one? I already explained it to you. The modified. In the modified, what are you going to do? You are going to build a bridge. You don't restate, but you do 1 year according to two methodology.
So you say
Old rules, old rules, two set of books. Old rules, new rules, and the difference line by line. I don't know which is the easier. I don't know which is the easier. Both of them are actually going to be a hard work.
So if you're using a retrospective, full retrospective, and there is a contract which is running over from 2004 to 2000.
So here,
No,
it stops here.
no, I'm using full retrospective,
Yeah.
and then there's a contract which is moving, which is part in 2014 and part in 2015.
You have to restate because it's in the period. Anything which is here, fine.
anything which is finished, you do not.
Yeah, everything which is after needs to be totally restated. No, I understand. Yes, you have to. Okay? What is the modified one? It's not better. Why? Because what you do is you do it only here,
But you still have the.
but everything needs to be reported. Two approaches. Yeah. Yay. We are done. With IFRS 15. Any questions?
Tomorrow.
Nah. Don't try to convince me that you are tired, because obviously you were sitting all day. So, I know. The major part of the funding. That's the third chapter. That's the third chapter. The second one, the list we are going to do tomorrow. It's on page 117. Now, regarding the financial instruments, IFRS 9 is, to be honest, it's now becoming, sorry guys, but ridiculous. And the reason for that, because they have been changing it every year, I don't know how often. But this time, actually, I think that now they achieved an understanding on two of the most contradictory situations. One of them is going to be the expected credit loss model, and the other one, which was very contradictory, was the hedge accounting. And now it seems that both of the situations are now resolved. The only issue is that if you take a look at the, well, where is IFRS being created? Which country? Where do they do it? So which is the country that you need to invade? It's actually it's in England, and it's not London anymore. It's very close to London. It's some now or something like this. It's close to London, 20 kilometers away. And the reason that they are struggling with it is what? First of all, because they wanted to arrive to a single model with who? With the US. And actually, United States of America, since they actually hurt themselves pretty bad. Because of what? Because of the credit crisis, and they were blaming accounting, and not just bad will, but never mind. So they were blaming accounting for the credit crisis. Yeah, right. They actually wanted a very strict expected credit loss model, and the European politicians were afraid that they are not going to be re-elected. So they were not able to agree. There was a huge clash. But now we arrived to a situation where it seems to be an understanding on the model. So actually, the financial instruments in 2014 July, because now we have to put even months, because IFRS 9 have even versions within the year. Okay? So the last version is 2014 July, where it seems we have the final one, except of a few small rules. And what we are going to talk about over here, we have to talk about the classification and the measurement rules. Because maybe, I mean, if you have been here last year, I was talking about the classification and measurement rules, and I told you that finally this is final. And I told you the main rules. I was wrong. Because they changed. Okay? So we need to go over the classification rules. Then we are going to talk about the expected credit losses. Okay? That's the new thing. Alright? That's the new thing. And everybody is excited what is going to be in the expected credit loss. And then actually the rest, the hedge accounting, I will take it to tomorrow. So tomorrow when you are going to wake up in the morning, can't wait until you reach here and you hear all these hedge accounting things. To be honest, the new hedge accounting rules are so complex.